In this video, we're going to talk about using an indicator as a stop loss for your trade. Stay tuned. Hey traders, a very warm welcome to you. So, stop losses, massive subject, multiple videos. I've done some videos on kind of fixed stops, stops on above key levels, but one thing we haven't talked about, which is quite a nice way of using stops, is to use an indicator based exit for your trade. Now this is more of a trading stop criteria. You're kind of going to want to use this as you're already in the trade. The trade is already in the cruise, it's already chugging along, and you say to yourself, hey, you know what, I'm going to come out of this if my indicator does this. Let's have a look at some ideas of some indicators we could potentially use. So example would be probably the one that springs to mind the easiest is something like a close below a moving average, for example. So if we were long on this breakout on US dollar JPY daily chart, we'd say to ourselves, what have we got here? We've got a 9, let me make it a 10, make it a round number, 10 period moving average. We're going to stay in the trade until the price closes below the 10 period moving average. For example, we could use a 20 period, a 50 if we wanted to give a bit more room. Obviously the tighter we go, the more kind of close to price it's going to be. If you had like a 5, you're going to be really close to price, but you're going to get stopped out on the first real down move. So that's going to be up to you depending on the sort of trade you're after, the sort of market you're trading and stuff like that. So for example, if you were fortunate enough to have caught this trade, whatever, you were buying a breakout, you had an initial stop of whatever, but now it's gone in your favor, it's running your way, and you say, you know what, any close now below the 10 period, I'm out. And in actual fact, in this example, you know, it keeps you all the way in right up to that point there. So very big move. Now obviously the point is, you know, that's obviously a rare scenario where we don't get that all the time, but it keeps you in even this move here. Let's say you were short on this resistance tag up here for whatever reason. Let's put a kind of a marker there, cancel that. You were short and you said, okay, I'm gonna trail it, and it closed below, and it closed above that 10 period, I'm out. Closed above here, great. Now obviously the disadvantage is you're going to give some back, and the wider that moving average, you're going to give some back. And let's look exactly how that would work in those two trade examples. So if we change that to a 20 period, if I can click it to a 20 period, which is another obviously popular moving average. There we are. You know, that's going to, it depends on the situation. You're going to give some back, but of course it's going to allow you for more noise. So what takes with one hand, it gives with the other. That's the beauty of trading. You know, there's no one right answer. You know, in this explosive move, you're going to stay in obviously until this point here, which is a little bit worse. But maybe if it had pushed on again from there, you would have another leg. If we talked about this example here, we were going short. In actual fact, that kept us in, by the look of it, up until here. So even though that actually gave back quite a lot, didn't it? So from 108 back to sort of 111, it's quite a lot to give back. But it's something to think about. And let's look at it from a shorter time frame perspective. If we put that to a 5 period, now that's extra aggressive, really tight, and that would be something we're looking for if we're looking for real breakout momentum expansion, volatility expansion strategy. 5 period, chug, all of a sudden we're out. So it's a multi-day move. It's a first kind of move away from us. So that's one way of looking at it. We could have a moving average, we're going to have a moving average crossover, something along an average price. So it's dampening down the move as a moving average does, and then coming out of the trade once it crosses a moving average. Beautiful way of getting involved with a trend. Now another example we could have is, let's put up a really popular oscillator like an RSI. Where are we? Relative strength index. Bang. Let's make it a little bit color so we can see what's going on. Thicken it up a bit as well. I go for white so we can see it on the board. Alright, so an example with an RSI would be something like, let's say that we're selling overbought conditions on RSI. So we're selling an overbought condition here on the US dollar JPY. Let's just get rid of this moving average so it's not so cluttered. And let's say we're going to stay in the trade until the price crosses the midpoint of the RSI. So we'd have a midpoint here at 50. And obviously it depends if we've got stochastics, it's going to be different. We have a midpoint there. We're going short here because it's oversold as it crosses back under into this kind of neutral territory from wherever we've got this. In this case, we've got it at 70 and we're looking to cover it at 50. Great. Or let's say we're just selling at a resistance level, not using the RSI as an entry. We're trailing it and saying, okay, we want to come out when we cross the 50, or we could say something like, hey, we want to come out if it suddenly goes oversold, or if it doesn't go oversold, we want to come out if it comes back up into the midpoint above that 50 level. So let's say we're, this is kind of where it really hits a sweet spot for doing this strategy. Let's say we did take a short trade there for double top or resistance level, whatever reason, overbought, doesn't really matter. We pushed down and we said, okay, our exit is oversold. We didn't quite get oversold, did we? We didn't quite get it. But at some point we might say, if it broke through to new lows and we didn't get oversold, we might be sort of shrewd enough to say, okay, well, if now the RSI crosses back above the midpoint, that'll be our exit. So we don't really care what price is doing, but as soon as that crosses above the midpoint, we're out. And that's going to be out at about this level here. So we're just sort of approximating it. So we're still in quite nicely. And of course, the good thing about the RSI is when momentum changes, it's going to move quite quickly. But the downside, of course, is you can't quantify your risk as well. You can't say, okay, well, that's X points multiplied by my position size. That's, £700 or 2,000, whatever it may be. You can't quantify it like that. It's more a case of, I don't know what that's going to be eventually, but I'm using that as a gauge. And that's not a bad way of trading, because you're really not trying to enforce your price and what you want on it. You're basically saying, hey, let price action tell me what's going to happen. Let price action dictate when I come out of the position, and if I time it right, it should be that the trade I'm taking is negated, because that's the whole point of a stop, guys, is that you take a stop where the hypothesis is wrong. If you're saying, hey, I'm shorting this and it's coming down, if the stock or the currency pair or index starts pushing back to highs and that starts going overbought again, you're obviously wrong. You need to get out of it. So using an indicator to give you that indication that it's time to cover the trade is a great way of doing it. Anyway, guys, let me know your thoughts on that, and also any other indicators you think are good. Perhaps Bollinger Bands, count the channels, that kind of stuff. Even if you don't use them to get into the trade, are they a good method and strategy to kind of help you stay in with the trade, to keep you trailing that stop higher and higher and higher, and letting price kind of pay you for being right? Let me know your thoughts below. Be interested to hear what you guys got to say. All right, take care, gents and ladies. See you soon. Bye-bye.